A financial earthquake is shaking Asia, and the tremors are already spreading across the globe. Japanese government bond yields have erupted to their highest levels in nearly 2 decades, sending shockwaves through global markets and triggering urgent warnings from analysts, who fear a dangerous chain reaction is now underway. Japan, long known as the world's quietest and most predictable bond market, has suddenly exploded with volatility. The benchmark 10-year Japanese government bond (JGB) yield has surged near 1.9%, its highest level since 2008. Meanwhile, the 2-year yield has vaulted above 1% for the first time in 17 years, and long-duration bonds, 20-year, 30-year, and 40-year maturities, are spiking violently. For a country that has lived under near-zero interest rates for decades, this is not normal. This is not gradual. This is a rupture. Financial commentators are calling it the most dramatic shift in Japan's bond market since the collapse of Lehman Brothers, and the consequences could be enormous. A perfect storm of pressure. What caused this explosion in yields? Analysts point to a perfect storm of forces converging simultaneously. 1. The Bank of Japan is losing control. After years of artificially suppressing yields through massive bond purchases, the Bank of Japan, BOJ, has been forced to loosen its grip. With inflation climbing, wages rising, and global rates surging, yield curve control is dead, and markets are now testing how high yields will go when left to the free market. 2. Japan is issuing a tidal wave of new debt. A massive government stimulus package, one of the largest in decades, is pouring trillions of yen into the economy. The government must issue huge amounts of new long-term bonds, flooding the market and pushing yields higher. 3. The global carry trade is unraveling. For years, investors borrowed cheaply in yen and invested in higher-yielding foreign debt, a lucrative strategy known as the yen carry trade. But with Japanese yields rising and the yen strengthening, these trades are blowing up. Money is being forced back into Japan, triggering turmoil in world markets. Global consequences could be severe. The fear is not just about Japan, it's about the world. Japan is the largest foreign holder of global bonds, from U.S. treasuries to emerging market debt. If Japanese yields stay elevated, capital could shift out of global markets and back home, draining liquidity, pushing up global interest rates, and hammering risk assets. Equities, cryptocurrencies, and high-growth tech stocks are already showing signs of stress. Financial institutions are bracing for possible liquidation waves. Hedge funds are sounding alarms over bond volatility. And currency traders are preparing for disorderly yen moves that could spill into broader FX markets. One analyst described the situation bluntly. If Japan is blowing up, the rest of the world won't be far behind. A warning for the future. What is emerging now is not just a rate adjustment. It's a historic repricing of the world's most important safe haven debt market. After decades of stability, Japan's bond market is waking up, and the awakening is violent. Higher yields mean higher borrowing costs for Japanese companies, a stronger yen that threatens exporters. Rising stress in global bond markets, a potential unwind of trillions in carry trade positions, a risk-off shock that could hit stocks, crypto, and real estate. This is not a Japan-only story. This is a global liquidity event in the making. The bottom line: Japan's yield surge is not just a statistic, it is a flashing red warning for global markets. As yields hit multi-year highs and volatility surges, investors worldwide are confronting a chilling possibility. The era of endless cheap money may be over, and the consequences could be brutal. This story is developing rapidly, and the next 48 hours may determine how far this shockwave spreads.